Good morning, hunters, and welcome back to the Daily Hunt for Multi-Baggers. It's Wednesday, February 4th, 2026, and we're here to break down the latest market insights from yesterday's data.
That's right, Ethan. Our AI dug deep into hundreds of thousands of social media posts, sifting through the noise to pinpoint some intriguing stock discussions.
And what a day it was, Brooke. We saw a significant volume of activity, flagging a good number of diverse stocks across various sectors. The overall sentiment, I'd say, was a real mixed bag. Some clear areas of promise, but definitely a lot of caution out there.
Absolutely. Our analysis, which combines user sentiment with critical financial KPIs, really shows a bifurcated market right now. Some companies are seeing intense bullish momentum, while others, let's just say the market is pushing them towards a tougher conversation.
Kicking things off today, let's talk about Broadcom Inc., AVGO. We saw quite a few posts about AVGO yesterday, around 17 of them. Now, Broadcom, is a powerhouse in semiconductors, especially with all the talk about AI. There's been some really positive news about their strong position in the AI chip market, even talk of revenue potentially doubling in the next couple of years. From a growth perspective, that sounds pretty compelling to me.
It does sound compelling, Ethan, but let's pump the brakes a bit there. While the long-term AI narrative is strong, our data, and especially the recent social media buzz, points to a strong bearish sentiment for AVGO, scoring a -7. We're seeing what our insights call bearish put sweeps in mega-cap tech, including AVGO. That means big institutional players are hedging or even betting against a price drop. When you look at the KPIs, its price-to-earnings ratio is sky-high at over 67, suggesting a lot of future growth is already priced in. Plus, a debt-to-equity ratio of over 166 is a significant red flag in an uncertain market. And insider selling is not exactly a vote of confidence. Broadcom has consistently been a stay-away for us recently, including last month on January 23rd.
Yeah, those are some stark numbers, Brooke. It's tough to ignore those put sweeps. For Broadcom, AVGO, the final verdict for today has to be stay away.
Next up, PayPal Holdings Inc., PYPL. This one, frankly, has been a source of a lot of pain for users. The sentiment is overwhelmingly bearish, hitting a -9 in our analysis. Many posts are talking about a dead cat bounce or literally calling it pain pal.
I get that user sentiment is rough, Brooke, and the stock is hovering near its 52-week low. But sometimes extreme pessimism can create opportunities. We're seeing a price-to-earnings ratio around 7.7, which on the surface looks incredibly cheap. Plus, there have been some net insider purchases recently, which could suggest a belief in a turnaround eventually.
Ethan, that PE of 7.7 looks like a classic value trap when you consider the context. The cat still falling narrative isn't just user frustration. It's backed by Q4 earnings and revenue misses, and multiple analyst downgrades cutting price targets significantly. High debt to equity at 60.2 and slower checkout growth indicate fundamental challenges. While insider buying can be a positive, it's heavily outweighed by the current operational weaknesses and market's lack of confidence. PayPal was a stay away for us back in October 2025, and that sentiment holds.
Given that grim outlook, I'd agree. For PayPal, PYPL, our verdict is stay away. All right, let's turn our attention to a tech giant, Microsoft Corporation, MSFT. A huge number of posts, over 220, were flagged for Microsoft yesterday. Now, while one analysis pointed to some bearish put sweeps and general market caution, we saw two other analyses indicating a cautiously bullish to outright bullish sentiment. Users are really highlighting Microsoft's strong moat, its leadership in AI and cloud services, and are treating any dips as a buy-the-dip opportunity for long-term gains. We're talking about incredible revenue growth of 16.7% and a whopping 39% net profit margin. And get this, significant insider buying over the last 6 months, totaling over 430,000 shares. That's a huge vote of confidence. Microsoft was a buy for us just yesterday. Ethan, I appreciate the optimism, but we can't ignore the short-term headwinds. Yes, strong fundamentals and insider buying are great for the long term, but the bearish put sweeps from institutional players are concerning. Also, news reports mentioned analysts cut Microsoft price targets, and Microsoft's pivotal AI product is running into big problems. That PE of 25.70, while reasonable for Microsoft, might be vulnerable if these AI challenges persist and growth expectations are tempered. It means the stock could definitely see some volatility in the near term. You're right to highlight those risks, Brooke. It's not a clear run. However, the sheer strength of those fundamentals and the long-term AI vision still make it very compelling. For Microsoft, MSFT, we're calling it a cautious buy today.
Moving on to a stock that's been in a tough spot, Figma Inc., FIG. We saw 10 posts on it, but honestly, user sentiment was pretty neutral and ambiguous. What really concerns me, Ethan, are the KPIs. The stock is trading alarmingly close to its 52-week low after plummeting from its high.
Yeah, I saw that. From a technical standpoint, that's a tough look.
It is. And fundamentally, it's deeply unprofitable, with negative net profit and operating margins. Couple that with a high debt-to-equity ratio of 4.41 and significant insider selling, over 1 million shares in the last 6 months. News reports confirm a stock slide, with headlines like, "Why Figma stock lost 31% in January." Fig was a stay away for us on January 14th, and frankly, I see no change. I agree, Brooke. The numbers are just too bleak right now. For Figma, FIG, we definitely say stay away. Now, let's talk about Advanced Micro Devices, AMD. This one generated a lot of buzz yesterday, over 360 posts. They just reported strong Q4 results, beating earnings and guidance. Their data center business is booming, and their MI450 AI accelerator is looking very promising for 2026. This is a company driving innovation in key growth areas. We actually had it as a buy on January 14th and 16th, before it went back to stay away more recently on January 3rd. Ethan, while the Q4 results were strong, the market reaction has been frustratingly bearish. Many users are confused and frustrated that the stock actually fell after beating expectations, calling it a sell the news event. This is a recurring pattern for AMD. Our data shows an extremely high price-to-earnings ratio of nearly 93. That tells me the market has incredibly demanding expectations, and even a beat isn't enough. Plus, its debt-to-equity is also quite high at 6.366, adding to the risk. News reports also mention a sequential quarterly decline in revenue, which can't be ignored for a growth stock with such a high valuation. It's been a stay away for us more often than not, including yesterday.
Those are valid concerns, Brooke. The market sentiment is clearly not aligning with the fundamental performance right now. For AMD, we're classifying it as stay away for now. Next, let's discuss Oracle Corporation, ORCL. With 12 posts, the sentiment from our analysis is strongly bearish at -7. The post highlighted bearish put sweeps in tech and general market caution.
I hear you on the bearish options activity, Brooke, but let's remember Oracle's long-term strategy. They've announced a massive AI funding plan and are launching AI tools for banks. That's a significant strategic shift with potential for future growth.
Future growth is great, Ethan, but we need to look at the immediate risks. Oracle's debt-to-equity ratio is astronomically high at over 432. That's a huge red flag, especially when analysts are cutting price targets as we've seen in recent news. The stock is significantly down from its 52-week high, and its PE of nearly 30 still feels elevated given the underlying financial leverage and market caution. Oracle has been a consistent stay away for us since October 2025.
Yeah, that debt figure is definitely hard to overlook. For Oracle, the verdict is stay away. Now for a really interesting one, Supermicro Computer Inc., SMCI. This company generated massive community engagement yesterday, over 180 posts, and the sentiment is overwhelmingly bullish. Users are celebrating incredible earnings beats for Q2 FY 2026, record revenue, a massive beat on both revenue and EPS. The company's guidance for Q3 and full year 2026 is also very strong, driven by intense AI demand. Some users are even talking about a potential 3x return this year. This is a dramatic turnaround, as it was a stay away for us yesterday, February 3rd.
It is quite the turnaround, Ethan, and the numbers are impressive. However, while the news reports are glowing with record revenue and 82% expected growth, our historical revenue growth KPI is actually negative at -15.5%. Now, this clearly indicates a significant recent shift. The current PE of 23.36 is reasonable for a growth stock, but the net profit margin is still relatively low at just under 3.8%. We need to ensure that this rapid growth translates into sustainable and expanding profitability, not just top-line expansion, you know?
Brooke, I think the market is clearly looking forward here. The strong demand from AI is a powerful tailwind, and the sheer volume of the revenue beat suggests they're capitalizing on it effectively. The current stock price, still relatively close to its 52-week low despite this incredible news, presents a compelling entry point for what looks like a genuine multi-bagger candidate. This is definitely an upgrade from its previous stay-away status. For Supermicro Computer, SMCI, our verdict is a strong buy.
Finally, let's talk about Netflix Inc., NFLX. We saw 36 posts about Netflix yesterday, and the sentiment is pretty bearish, scoring in -7. Users are very skeptical about any short-term gains, with comments suggesting the stock is pinned in the 80s.
Well, Netflix does have long-term strategic plays, like the potential Warner Bros. Discovery deal. While it's facing regulatory scrutiny, a successful integration could unlock huge value. Plus, there has been some net insider buying recently. We actually rated it a buy on January 27th.
But Ethan, that potential WBD deal is under intense antitrust scrutiny from a Senate panel, creating a huge cloud of uncertainty. The stock is currently trading right near its 52-week low after a consistent downtrend. A PE ratio of over 31 is still quite high for a company facing regulatory headwinds and struggling with market perception, despite those insider buys. The overall consensus is that short-term speculative bets are extremely risky. Given this new data, it looks like a downgrade from its previous buy.
Yeah, the short-term outlook looks too challenging. For Netflix, NFLX, we classify it as stay away. All right, Brooke, that was quite the ride through yesterday's market action. Let's wrap up with our compiled list for deeper analysis. Investigate as buy, Supermicro, SMCI. Investigate as cautious buy, Microsoft Corporation, MSFT. Investigate as speculative gamble, Advanced Micro Devices, AMD. And that's our deep dive for today. Remember, the market is constantly evolving, and yesterday's hot lead might be tomorrow's cautionary tale. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in to the Daily Hunt for Multibaggers. We'll catch you tomorrow morning with more insights.
Happy hunting!